What a crazy week this has been. It is finally here, it is official, and we should have seen it coming because McDonald's raised the price of their cheeseburgers for the first time in 14 years. You were the chosen one. Now, the second quarter advance estimate came out this Thursday, and the results are negative 0.9%, which means the recession is officially here, which is not a surprise to most people. But you see, we can't really be in a recession if we change the definition.
Then why is it the White House officials are trying to redefine recession?
Because that's not the definition.
Hold on now, that might be a good point. What does it mean to be in a recession? Let's ask the scroll of truth and Google that. And Google says, generally identified by a fall in GDP in 2 successive quarters. Yeah. Okay, so everyone is arguing over what it means to be in a recession, and by everyone I mean mostly the White House, but what does it actually mean? I did some homework, and according to the White House's economic research team, the NBER defines it as a significant decline in economic activity that is spread across the economy and lasts more than a few months. The committee explicitly rejects the outdated definition of a recession as 2 consecutive quarters of negative economic growth. So that leaves kind of a very open-ended definition to what a recession is, and that wasn't good enough for me because I want specifics and I want data, and as I looked more into this, I figured out exactly what the government wants us to look at. So the NBER says that a recession is normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. So including the GDP, that's 4 additional economic data points the government wants us to look at instead. And by the way, anytime you hear the word real in a measurement, like real income, all that's doing is it's taking inflation and subtracting it from the data, which is a good thing because it makes it more accurate. Now, what I'm about to show you was released from the White House that shows economic data that implies that we're expanding. But it's only partially true and a little misleading because they give us more data than we need, which makes it look a little bit rosier than the real picture is. So let me show you that right now and help break it down and explain exactly what the government thinks a recession is. So this first line right here represents something called non-farm payrolls. And this line represents the amount of people working in the US, excluding farm work, because it's more cyclical. Now, just for context, let me show you that same graph, but only for this year. And as you can see, yes, so far this year, the amount of people working has actually gone up. And this is good because the more people working, the more stuff we get to produce, the better the economy is doing. So that part is true and it's all good. Now, the second chart right here is real personal consumption expenditures. This is the Federal Reserve's favorite way of measuring consumer spending. Now, sometimes that chart was referred to as the PCE, which is the lesser known metric. The one we know about is the CPI, the Consumer Price Index. But the Federal Reserve considers the PCE to be more broad and encompassing, so here's that same chart again, but only for this year. And you can see the consumer spending is going up and now it's starting to cool down. But economists want this line to be closer to 2%, which is not where it's at right now. Now, the easiest way to think about the chart you just saw is that if you see a PCE that goes up, that implies that we're having a higher inflation. If you see a decline in the PCE, that means probably deflation. Now, in a recession, the PCE tends to be low, flat, or maybe declining because that's when consumers are spending less money or they're not spending money at all because we're in a recession. And when we don't spend money, we're not stimulating the economy, which is a bad thing. Now, the government looks at our current PCE level, which you can see at the end is starting to slow down, and says, this is healthy. Consumers are still out there spending money. But consumers are saying, well, of course we're spending money. Inflation's ridiculously high, so we have to spend more money. So this one is kind of debatable, and it depends on which side of the fence you're on, but that's a way to think about this. The third chart is this, real income less transfers, which looks normal. But instead, we should look at real personal incomes because that's what the NBER themselves have told us to look at, which you can see here has gone down this year, which is definitely not good. So what this means is that Americans are getting paid more, which makes for a great headline. But the reality is, thanks to inflation, our real incomes have actually gone down this year, which is obviously not a good thing. Now, the last thing the government wants us to look at is this one, industrial production, which has also gone up, and this is a good thing because that means we're making more stuff. So 2 out of 4 of these metrics are not doing as well as they should in a healthy economy. And if we add in the GDP, which we found out this week that the economy is contracting, then actually 3 out of 5 are not not doing good. Now, the government would argue that the PCE is just fine, so 3 out of 5 for them are doing good. So again, it depends on which side you're on. If you're a consumer, of course you're going to say that the economy's not doing good because you feel the effects of inflation. You could almost taste it. It was just weird. That's what he said. It was weird. It was funny. But if you're a government official who might be afraid of losing their job right now, of course you would say that 3 out of 5 are doing just fine. So it really depends. So I would argue that a more important question to ask is, are all these metrics the same, or is one more important than the other? And this is the punchline that I can't make up. This is what the NBER says. We view real GDP as the single best measure of aggregate economic activity. So the GDP is kind of important, but not really. It's only the most important thing we have, but it's going down, but don't worry about it. It's all really confusing, so that's the recession from all points of views, and I'll let you decide what you think. And in today's video, I want to talk about today's data, because the GDP data that we just got this week is already 3 months old, and it does not mean that we're in a recession now. And then later in the video, I want to answer the question that's arguably more important than are we in a recession now, which is, what does it mean to be in one, and how is it going to affect us? So with that said, let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the crazy long intro. So first, we'll talk about what happened with interest rates this week, and then I want to help explain and share some data that really blew my mind. So first, we had the FOMC, aka Illuminati meeting, with Papa Powell increasing what's called the federal funds rate by 0.75%. And remember, that's the cost for banks to borrow money from the Fed. So now the federal funds rate went up from 1.5 to 2.25%, or to 225 basis points. So what does this mean? This means that savers are about to make a little bit more in their savings accounts, and borrowers are about to spend a lot more. So auto loans, home loans, student loans are all about to go up. But when it comes to asset prices like real estate and the stock market, that puts a downward pressure on prices. Now, usually when the central bank increases what's called the federal funds rate, the stock market doesn't like that. It likes cheap money so that it could use to buy back more of its own stock. Share buybacks. But in this case, the stock market went up on Wednesday 2.6% and 1.26% on Thursday. And sometimes the market doesn't make any sense and it sells off the next day, which is why I never try to time it. But the second reason the stock market is going up is because Papa Powell is doing exactly what the market is expecting him to. In other words, whenever the stock market makes a forward prediction, and anytime it ends up being right, the market goes up. If it ends up being wrong, it goes down, because the market does not like uncertainty. And believe it or not, the stock market has already made its next prediction. And here's what it is. Using the CME Fed Watch tool, you can see that right now, the market is predicting a 65% chance that the federal fund rate will be between 2.75 and 3%. So that's the stock market's next prediction. But here's the thing. Between now and the next interest rate increase, there's going to be 2 more inflation reports, and a lot can change. The first one on August 10th for July's inflation, and the next one on September 13th for August's inflation. So here is specifically the data you have to pay attention to. If we find out that inflation is 9.1% or above in those next 2 inflation reports, that's when he'll increase the federal funds rate by at least 0.75%. That's when the market will probably go up, because that's what it's predicting. And the reason I say 9.1% specifically is because that's what the last inflation report was for June. And what he's looking for is the inflection point when we've reached the peak and then inflation starts to go down. Because as of right now, we have no idea how high inflation will actually go, because it's still going up. Now, if inflation is anything lower than 9.1%, he might increase the federal funds rate by only 0.5%, in which case the market could go in either direction. But either way, what the market does not want to see is fall asleep at the wheel and not increase the interest rates at all. Now let's talk about whether we're in a recession right now or not. But first, a quick word from today's sponsor. I just want to quickly say that I spent a lot of time here at my desk, so I'm sure you understand why it's so important to have high quality and reliable technology to boost efficiency and keep things clean and organized, which is how I'm able to make my videos. And that's why I love Anker, and I'm so happy to have them as the sponsor of today's video. Anker just released their new GaN Prime series, the best multi-device fast charging lineup, with a total of 6 new chargers. Now, these are a game changer because they can charge all my higher wattage devices at the same time, which means I can plug in my laptop, my phone, and my tablet at the same time so I can continue working to research my videos. And the ActiveShield 2.0 technology offers extra protection by monitoring temperature and adjusting the power output to safeguard all my devices so I never have to worry. Now, the PowerIQ 4.0 also auto-detects the power requirements of my devices and dynamically distributes the output between them in real time to deliver faster charging times for multiple devices and increase energy efficiency. And the best part is that now these chargers come with a reduced size of up to 53% while also lowering the operating temperature. And that makes them sleek and portable and easy to grab on the go so I can make my finance videos while I travel while contributing to less e-waste thanks to the multi-port design. Thank you, Anker, for sponsoring this portion of the video. Now let's get back to it. Here's a cool little nerdy fun fact. Economists are always looking for their mythical common denominator. In other words, something that is true in every single recession that happens right before a recession. Because if we can find it, we'd be able to use this information to predict when the next one is coming. And so far, we don't have a single one. There's nothing that exists out there like it because everything we've ever used has always been in the past after a recession has happened. But the closest thing we have is something that was posted just recently to the Fred St. Louis website on October 2019, and it's called the Somm Rule, created by economist Claudia Somm. And she found out that whenever there was a spike to unemployment above a certain point in the last 12 months, that's when there has been a recession. And this rule has been true with every single recession since the start of 1970. And here's how it works. Check this out. If 3 months before these red areas, which are recessions, the unemployment numbers are at any point 0.5% higher than the lowest point in the last 12 months before the red areas, there's a chance we'd get a recession. Right now, the Somm number is actually at 0, which means in the last 3 months, our unemployment numbers have not spiked 0.5% higher than our lowest point in the last 12 months, which means there's a good chance we're not in a recession, at least as of 1 month ago. Because remember, all of this data is in the past. The Somm rule is 1 month behind, but the GDP is 3 months behind, so it's way more dated. And I know all of this stuff is extremely complicated, so if you've made it this far, here are my personal thoughts that no one asked for. Please understand, I'm not an economist. I'm just someone random on YouTube who's trying to make sense of the complexity that is the economy. And I don't like to share my perspectives and my opinions because I don't think those are valuable. Everybody has those. What's more valuable is presenting information in a way that people can understand the data and the information so that you could make up your own mind. But I think we could all agree that the central bank definitely fumbled inflation. They didn't take it seriously, they thought it was transitory, and by the time they increased interest rates, it was just too little too late, and it got away from them. So they should have been more proactive rather than reactive. On the other hand, I can understand why they took their time. Because after the 2020 recession, no one knew how sensitive the economy was. So raising interest rates too quickly and too high could have damaged the recovery. So I understand from that perspective why Chairman Jerome Powell took his sweet time to understand and see how strong the economy actually was. And if I was in his shoes, I'm not sure I would have made the right decision either. So I try to see it from all perspectives. Either way, I think one of the best takes was from Joe Weisenthal on Twitter, who said, "The economy is what it is. It doesn't matter what we call it. Just consider what it is today. Inflation is high, the labor market grew in the first half of this year, tons of job openings still out there, and even though there's wage growth, it's actually negative when compared to inflation, and now it looks like we're slowing down." So labeling this a recession doesn't tell us anything more about the economy that we don't already know. But what matters more is the word recession and how it's perceived. We don't want to scare people. We don't want to scare employers into stop hiring people or letting people go, because that would be very bad. So instead, the takeaway that I have for myself is that so far this year, there are plenty jobs still out there, and life is still becoming more expensive because inflation's still going up, and therefore interest rates are going up, so it's a lot more expensive to borrow money. Therefore, consumer spending is gonna have to come down, which it already started doing. And it'll probably take anywhere between 12 to 18 months for everything to really start to cool off. Because think about it, everything we feel now in terms of inflation is because of the stimulus that happened 12 to 18 months ago. That was a while back. So just like we're experiencing the crunch of interest rates going up, that won't be felt until a while from now. The middle of next year to the end of next year, I'd say, is when we really start to feel the effects of all this slowdown. But regardless of what happens, I'm still gonna continue to dollar cost average into the market and definitely lower my spending. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Go grab up to $250 worth of free Bitcoin right here. Please remember, do not keep your Bitcoin and your crypto online. Get the free money, move it offline to a cold storage wallet, and don't forget to grab your free stocks. Links are down below, and then go track them automatically with a spreadsheet linked down below in my Patreon. Love you. Thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes a Wednesday. Crazy week. I'll see you in the next one. Bye-bye.